Manish, before you just came, we were setting the stage that why this budget is going to be important one. This will be the last one for this budget, the last full budget for this government. And before we talk about markets and how markets are right now approaching the budget, I asked a question from Anand to take stock of where corporate India stands right now. We've seen last 4 years, in fact, we talk about earnings recovery. Are there glimpses now, especially after GST implementation and demonetization? How are things chugging back to normalcy? What is the situation right now?
Thank you. I think if you look at it from a macroeconomic perspective, things look really rosy over the last few years. The current account was under control, the fiscal deficit was under control, and double-digit inflation, we were able to literally halve to in the vicinity of about 5%. And I think in that context, perhaps some of that tailwinds, I'm not saying that, any of this is going to blow out anytime soon, but, the ability of some of these macroeconomic numbers to provide, provide tailwinds is perhaps muted, especially in the context of the fact that maybe we're going to see some fiscal slippage this year. Oil prices have, sort of gone up significantly over the last year or so. But having said that, I think on the other side, ultimately, markets move, based on earnings. And I do believe that we are already seeing early signs of the fact that demand across sectors is certainly improving. We had two very big events last year, demonetization and GST. I think much of the impact of that is behind us. And if not anything else, because of base effect, I think some of the numbers are certainly are going to look much better, as we go forward. Our own estimates, as per our economist, is that growth numbers, which have been relatively muted, will move back into the 7.5% vicinity in 18-19. And I think, if not anything else, just because of that, we should certainly see, the corporate earnings beginning to look much healthier than they have certainly over the last 2 years.
Anup, this NCLT mechanism which we were talking about, how do you rate the kind of work done so far? Because we are seeing the high quality global investors also starting to take a look at these stressed assets now. Do you think this is something which the government has really worked for government?
No, I think so. Again, it's one of those strategies or plans which is very good on paper. Unfortunately, they are going to test a new plan with the most complex and the largest cases first. Normally, when you do roll out a complex mechanism, you first try it on the smaller cases and away from the publicity. But this time, because we didn't have time, it will be tested on the larger cases. So I think so. How it goes in our terms of our judicial process will be very important. I think so. They will be bidding, and bidders will emerge who are the highest bidders. It's the question of whether they can go and actually take charge of that asset, which will be really the thing to be seen and tested. Because in India, justice is always delivered after it is delayed. So I think so from that point of view, the real factor to watch is not this process of NCLT and bidding. It's the kind of action that can be taken and how fast how fast it gets just then decided by the judiciary. And if that goes through, then we'll really see some very active foreign investors in this, because their bigger worry with India is that on paper we are very promising, but in reality we are just a bit too frustrating to actually get things done on the ground.
Mr. Sivakumar, if you were to vote in favor of giving them a little rope on the fiscal consolidation path, or would you want them to stick to that path and compromise in growth, which you think is eventually coming back because the cycle is turning?
No, the latter question is much easier. That is growth coming back? I would say the short answer is yes. There is reasonable evidence that there is some pickup in activity. On the fiscal question, I would certainly say go for consolidation, because one very important metric that is lost is when especially when external agencies look at us, or even from a macroeconomic perspective, it is not just the center's deficit which matters, it's what's called general government deficit, when you add the state deficits together. And when you add the state deficits, which is another 3% plus of GDP, you suddenly are not actually running 3.2 or 3.5, but we are actually running 6.5% of GDP. That's just too high, and that's the reason why inflation is persistent, that's the reason why interest rates are high. If you genuinely want to make a step change, or you want to make a significant change to the outlook for inflation, interest rates and growth, then the combined deficit needs to come down. And in fiscal 2008, the combined deficit was 4% of GDP, 2.5 at the center, 1.5 at the states. And we are now, seem to be happy with 7. I think we just have to stop being so complacent about the state of the fisc. The state of the fisc is weak, and I would simply say vote in favor of much tighter fisc than wider fisc.
Manish, what about you? A couple of things you would like government to focus on this time around as an investment manager.
I think a higher fisc is okay if it stimulates growth. In fact, I think the only way you're going to fix the fisc is by growth. So to that extent, I think if they do tax rate cuts both for corporate and individual, I think that's okay. Clearly, you want spending in the areas of infrastructure, housing, and anything that improves productivity. I think roads, railways already happening. So I would look at these two things, basically.
Anand, what is the probability you would assign for rationalizing taxes, direct taxes, income taxes? Because compliance seem to be going higher, right?
That's the intent. I think one of the things that this government has been trying to work very hard on, and Gautam spoke about, the 3 measures to be able to increase the tax base, demonetization, GST, and to ensure that tax compliance begins to improve, and this whole focus on increasing digital transactions. I think, to my mind, that's still work in progress. We may see some improvement in terms of tax to GDP ratio, etc. But I'd be very surprised if we see rationalization of taxes this year.
Naren, a lot of studies have also indicate that after a reasonable fall in interest rates as well as bond yields, and when slight rebound actually happens of inflation and bond yields, it is also an indication that the growth is actually coming back. To what level of inflation and the range of bond yields do you think the equity markets will not be perturbed a whole lot?
I think clearly, equity market is not perturbed about it. It's very evident at this point of time. I think, in fact, if you look at the entire debate globally after 2008, it was against deflation. And that's why some amount of inflation is really good from an India perspective. I think the big debates which are going to happen is if oil continues to go up, we should not go back to that old subsidy regimes, because actually the whole debate in India is about fiscal deficit, but actually the debate should have been about revenue deficit. It's pretty surprising that people are focused in India only on fiscal deficit, because everyone in India knows we have to spend on infrastructure. Sure. So I believe that what's going to be material is if oil continues to go up, whether the government continues to pass the increases and keep subsidies under control and does not go back to that older phase, because we went through a phase between 2004 and 8 when oil prices were not passed on, and that resulted in a number of macroeconomic problems which has hurt us actually in 2010 to 13.
In fact, why go far? Last 2 months, the oil marketing companies have again gone slow in passing on the crude oil prices, and hence the valuation got a little hit. So the market was slightly worried on that part once again, isn't it?
Yeah, but I think prices have gone up is what I have been told. So, I would say that as long as you don't go back to the subsidy regimes, I think it's that itself would be a big achievement, because it is only when oil goes up you're going to test whether we are going to have free market pricing of petrol and diesel. I think in our point of view, I think the growth impulse is going to be there if NCLT results in the issues, some of the problem assets getting resolved. Then you have another big kicker, because many of these projects can then be utilized fully. And actually that would mean that capex isn't required, and therefore actually you can spend all that on infrastructure. So I think the entire debate right now is, for me, is that revenue deficit should be under control. Fiscal deficit is needed in India because we need to create capacity, infrastructure across the country. That's how I look at it.
How are you analyzing the market right now? You know, on the earnings recovery front, has market priced in a full recovery?
See, I think from a market point of view, from a cycle point of view, I'm not worried.
Right.
Actually, because I believe that earnings hasn't come for 4 years, earnings will come in the next 2 years. Clearly, capacity utilization is below trend, it will go up. So I would say from a cycle point of view, there has never been a problem in the last 1 or 2 years. The challenge is only that you have global markets going up every day, and you have everyone investing a lot of the savings in equities without realizing that equities can give downsides at some point of time. So I don't think it's a problem of cycle or economy. It's more a problem of how people are handling their monies and are getting too equity focused at this point.
So if one were to talk about on a portfolio level, 5-7% volatility, the next 2-3 year landscape looks comfortable to you?
I think no, markets don't give you low volatility because you don't want volatility. So I think markets have a mind of their own, and so I would say that most of us in equity markets would want to have very moderated falls, but a number of investors haven't seen even 2011 where equity markets fell 25%. So I would say that, you know, for me, the 2015-16 volatility was very useful because people were aware of the risk. But post demon, we have not seen any correction in equities. And I love to see corrections primarily because I feel then people recognize risk. Otherwise, with every passing month, and this has happened globally, even more than in India, where people have stopped believing that equity
Corrections are part of the market. But perhaps people also start taking very healthy returns for their portfolios for granted.
Yeah.
And it's a risk, it could be the risky asset. Anup, you briefly spoke about how infrastructure is an area where, as a pocket, is looking good. It's a wide, sector to talk about. There are roads, ports, large asset owners. Spend some, give us some thoughts about why that area is looking good and how promising is the earnings prospect of infrastructure.
So yeah, it's a term which is fairly well abused by everyone. So I'll keep it very limited to a few segments. One is in terms of, if you look at the contracting companies which do the EPC work, I think so there are very few of them left which are still solvent. A large number of them have passed into various stages of comatose. But the ones which are solvent have got businesses of the level that they've not seen before, and we'll see companies coming and delivering 20% ROC, which is the Lakshman Rekha for a company or a business segment to become legitimate, because we are all actually we are all investors who pride to buy companies that are good quality, and nobody says that I actually buy momentum. So they'll all become good quality companies when we see their balance sheets for FY18. You'll see a few of them reporting 20% ROC, and they have visibility for earnings growth for at least 2 years, which you don't see for large segments of market. Now, within infrastructure also you have the space of metals, which is included in all infrastructure space as such. Again, there we are seeing very high growth earnings. One is because of low base of the last few years, and B is that we have price increase that's happened. So those are the two segments which in terms of earnings growth should sustain the kind of optimism which is built into their stock prices. How much of it has played out, how much of it will play out, it depends on how the market really behaves at that point of time. The second segment, which is a bit more controversial, is actually banks which have got if you look at banks which have got more exposure towards corporate side, where there has been a lot of, an issue of bad debt. So if you look at PSU banks, or if you look at the private sector corporate banks, if you look at any estimate from the sell side, this segment will be the largest contributor to the case of, that if you look at that, if you look at the case of earnings for the next 3 years, almost 25% of the earnings growth will come from this segment. So these are the three segments where there is going to be the most amount of visibility of earnings. In two of those cases, you have very high visibility today. In the third case, which is the case of corporate banks, it's going to be more of a that's going to be more of a fit and start kind of approach.
But you're also playing corporate banks as an infrastructure story because
We are not. We're not playing that. So I said one in terms of the case of infrastructure space would be the case of all these EPC contractors, whether they're in transmission, whether they're in roads, and B is the case of metal, which is also included in terms of infrastructure. And the second segment, which we think will have high earnings growth, will be the case of corporate banks.
Manish, you spoke about that railways is one area. You briefly hinted that a lot of work is going on already. How do you think stock market is capturing the work in railways? There are hardly any wagon companies. Or you think metals is an area where incrementally railway-related work can come? And also power. Because power, as Naren was saying, the situation has improved, the availability of power in the last couple of years. And tier 2, tier 3 is getting more number of hours as regular power supply. How are you looking at these from the stock market point of view?
So, railways is obviously a bit more difficult to play in the stock market because, as you said, very handful of companies and you don't get any direct plays there. To extrapolate railways as a big part of demand of metals is also not fair, I think.
Okay.
I think power is more interesting. I think any sector which has seen a collapse of capex from a 3 to 5 year perspective is definitely interesting. So I think today there is hardly any power generation capex, and because power demand has been growing only at 4-5%, there is a buffer that we don't need capacity for 4-5 years maybe. But if the economy were to pick up, I would think that since it takes a fair amount of time to put up that capex, that is a good part of the market to be.
Power and capital goods?
So I think the first line of beneficiaries is probably the utilities. The capex side is a bit more muddled also because there is a technology change from thermal to renewables. But I do think that utilities, power utilities are one of the more interesting spaces in the market currently.
Anand, not as a banker, but as a financial market veteran, I would like you to analyze the financials as a space for us. There is PSU banks, again, high quality to relatively lower quality in terms of the model business model they are running. Then there is private sector banks, which are both retail and corporate, and NBFCs, which have seen a huge last 4-5 years area of growth, but now they are getting perhaps some more competition in the credit side. And of course, bond yields have come back. Not as a fund manager, but just analyze the business environment for us.
So I think the three entities that you spoke about basically are playing the large, the retail opportunity, particularly the private sector banks and the NBFCs. I think like I said, the runway for growth on this is, continues to be really strong. One of the things that, the NBFCs have certainly benefited from, like you said, is the fact that interest rates have come off. So perhaps, I think we've got to differentiate between the business model and valuations. I think, as management, sort of you're focused on building the business model and continuing to deliver on that on a year-on-year basis. Valuations are whatever the markets do at various points in time. But I think what we're also seeing is now you can actually build a well-diversified banking and financial services basket, not just in public sector banks, but in private sector banks, large and small.
And there is a representation
and
of
there
insurance.
and there is NBFCs, and now you also have insurance and asset management companies. And I think that's one of the things which is unique to in the Indian context. As you think about yourself relative to some of the other markets, I mean, most of the other emerging markets are, either tech companies are overweight in the index, or sort of oil or metal companies are part of the index. But in India, the index gives you a whole gamut of world-class companies, across an entire gamut of industries, whether it is pharma, banking and financial services, which is, like I said, is getting more and more diversified, technology, oil and gas, IT and so on and so forth. And I think that really is the beauty of the Indian markets.
Naren, just a quick word on the area of the market which directly doesn't get impacted by government intervention, but the government actually has benefited in a way. The commodity rebound, oil and gas companies got re-rated, city gas distribution companies because of virtual monopolies also got a lot of favor from the investor community, and of course the entire metal play. You were some of the early people who caught that rebound in metals early. How do you see that pocket for Indian markets, the commodity market pocket?
Actually, commodity for us, if oil goes up, it's bad. That's a simple, straightforward thing because it hurts both our current account deficit and our ability to handle inflation, fiscal deficit, etc. So I would say that as long as we had a situation where metal prices went up and oil prices did not go up, which was the phase till last August, I think it was a great situation. But once we have seen oil go up as fast as metal prices, then I don't think it benefits the Indian economy. It benefits certain specific companies, certainly. But from an economy point of view, I think clearly there are more challenges. I have seen that duration, that is interest rates keep going up. As long as oil goes up, interest rates go up. So if you see 2004 to 13, when oil kept on, was higher, I don't think in that period interest rates ever could go down. The day oil fell, you had all these good scope for interest rates to come down. So luckily, equities are less affected because what I found interesting is when oil comes down substantially, the oil exporting countries who have invested in Indian equity start selling. So similarly, when oil goes up, I think they seem to be investing in India, which is why oil and equities are reasonably correlated, but oil and debt is not.
In fact, we've seen example of Norwegian fund which started massive redemption when oil fell down. Mr. Sivakumar, what's your call? Are rates, have rates in India troughed out and are set for some meaningful upside or maybe a little upside and then they may remain range bound?
So my own call is that even though the yields seem to have priced in most of the risks, that does not mean they will drop from here. As long as the deficit numbers remain where they are and with the outlook on oil inflation and RBI being reasonably hawkish, we expect the yields to broadly remain elevated, although not necessarily that it has to keep going up. Now, of course, one deciding factor in this is what RBI will do. And while they have been somewhat hawkish, we must remember that their last action this past August was to cut rates.
Sure.
So it doesn't seem quite plausible given the movement in the market yields. But given that they just cut rates a few months ago, it's very unlikely that they're going to switch around and start hiking soon. And that will be the biggest positive that I see for the markets, that the markets are probably already priced in too much of hawkishness. And as RBI probably is not actually as hawkish as people think they are, and probably the biggest positive that we can see for bond markets this year.
Manish, before we wrap out of this discussion, a quick word on the broader markets. I'm sure in the last 24 months, within equity, the allocation towards broader markets from a retail investor to a perhaps HNI investor has only moved upwards. And the data shows that in the last 3 years, BSE 500 companies, 50% of those companies are multi-baggers already. So that's the kind of movement broader markets have already given. What does your observation say on broader market? Are there pockets of fraud as overall broader markets have got re-rated and are already factoring in huge earnings growth? Or you think that there are still opportunities of value there in broader markets, mid and small?
No, clearly when you see such kind of appreciation, like last year the small cap index itself was up 55–60%. So clearly when you see that kind of appreciation, I think it's fair to assume that there is very, very little value left in the broader market. So I think it's important for investors to allocate to funds with larger allocation to large caps rather than small caps at this point of time.
Thank you very much for listening to the entire conversation patiently. I hope you enjoyed the same way as I enjoyed conducting it.